Ladies and gentlemen, investors, speculators, and students of history, what you're about to hear may shock you, but it will also prepare you. Throughout my career, I've watched markets move in rhythms that only reveal themselves to the patient and the observant. Today, we stand on the edge of one of those rare moments with silver not merely rising, but on the cusp of something unimaginable. I'm not here to whisper sweet predictions or pander to optimism. I'm here to tell you what the data, the structural forces, and the truth of markets are screaming at us right now. When you study markets long enough, you stop listening to the noise and you start watching behavior. Prices don't move first because of headlines. They move because something underneath has already changed. Silver's doing that right now quietly at first, then suddenly, and now in a way that's becoming impossible to ignore. I've seen this pattern before in commodities all over the world. Sugar, oil, agriculture, metals, and it always starts the same way. The market refuses to go down even when everyone expects it to. For years, silver was treated as an afterthought. Too volatile, too small, too manipulated, too boring. Pick your excuse. And while people were distracted with fashionable assets and paper promises, silver was building pressure, not excitement. Pressure that's far more important. Markets don't explode from excitement. They explode from neglect meeting reality. Look at what silver has done recently. It didn't just bounce. It didn't just recover. It pushed through levels that had capped it for years. Every time sellers thought they had control, the market absorbed supply and moved higher anyway. That's not luck. That's not speculation. That's momentum born from fundamentals asserting themselves whether participants like it or not. What most people misunderstand about momentum is that it's not about speed. It's about persistence. A market that keeps advancing despite bad news, despite skepticism, despite intervention is telling you something. It's saying supply is tighter than advertised and demand is stronger than admitted. Silver fits that description perfectly. This is not a story about one country or one event. Its global industrial demand keeps growing not in theory, but in factories, grids, and technology that actually consumes metal. At the same time, production isn't responding. Mines don't open because prices might go up. They open because capital is committed years in advance, and that hasn't happened at the scale people assume. You can't print silver. You can't create it with policy. You either dig it out of the ground or you don't. Meanwhile, inventories, the real kind, not paper claims, have been quietly drawn down. That matters more than any chart. When physical material becomes harder to source, prices don't ask for permission to rise. They simply do. And that's exactly what silver has been signaling. What really catches my attention is how the market behaves on pullbacks. Weak markets collapse on fear. Strong markets pause, shake people out, and then resume higher. Silver has been doing the latter. Each dip is shorter. Each recovery is stronger. That's the kind of behavior you see at the early stages of major commodity moves, not the end of them. People like to argue about manipulation. And yes, markets can be distorted for a time, but I've learned something traveling and investing across decades. Manipulation works until it doesn't. Reality always wins when enough pressure builds from shortages, from demand, from macro stress. Even the strongest hands lose control. Silver feels closer to that point than it has in a very long time. Another thing experienced investors notice is relative performance. Silver has begun to outperform not just its own history, but other assets competing for attention. That's important. Capital flows don't move randomly. When money starts rotating into a long-ignored asset, it's rarely for a quick trade. It's usually because larger players are positioning ahead of something they believe is unavoidable. And let's be clear, this isn't about optimism. I'm not optimistic by nature. I'm observant. Momentum like this doesn't form in comfortable environments. It forms when systems are strained, when confidence in paper weakens, and when tangible assets start to matter again. Silver sits right at that intersection. Monetary, metal, industrial necessity, finite supply. What makes this moment dangerous for the unprepared is how quickly perception can shift. For years, silver was dismissed. Then it becomes interesting. Then suddenly it becomes urgent. By the time everyone agrees it's essential, the easy part of the move is long gone. That's how markets punish complacency. I'm not telling anyone to chase price. Chasing is how people lose money. I'm saying pay attention. Markets speak long before they shout. Silver has been speaking for some time now, and the message is getting louder. When momentum aligns with fundamentals, history, and scarcity, you don't argue with it. You respect it. Because when commodities finally move after years of suppression and disbelief, they don't ask whether the world is ready. They simply remind everyone that reality sooner or later always asserts itself. Forecasts are cheap. Anyone can throw out a number and sound confident. What matters is why a market might go there, and whether the forces behind it are powerful enough to overwhelm doubt, disbelief, and resistance. When someone talks about silver moving to levels that sound outrageous today, most people laugh. That reaction itself is usually the first clue that the idea deserves serious attention. I've learned over decades that the biggest moves never feel reasonable at the start. If they did, they wouldn't be big. They would already be priced in. Silver has a long history of doing things that make people uncomfortable precisely because it lives at the intersection of money, industry, and psychology. When it moves, it doesn't tiptoe. It redefines what people thought was possible. The reason projections for silver sound so extreme is because people are anchoring to a world that no longer exists. They assume currencies behave, debt stays manageable, and confidence remains intact. But markets don't operate on assumptions. They operate on stress, and stress is building everywhere you look. Governments borrow without restraint. Central banks expand balance sheets without consequence until there is one. History shows that when trust in paper weakens tangible assets, don't rise politely, they surge. Silver is uniquely positioned in that environment. It's not just a hedge, it's a necessity. Unlike gold, which mostly sits still once it's mined, silver is consumed. It disappears into electronics, energy systems, medical uses, places where it doesn't come back to the market easily. That means every ounce used is an ounce that must be replaced. And replacement is getting harder, not easier. Now combine that with a price structure that has spent years compressing. Long periods of stagnation are not signs of weakness. They are signs of stored energy. Markets coil, pressure builds, eventually something gives. When that release happens, price doesn't move in a smooth curve. It gaps. It shocks. It forces revaluation. That's when people start asking how they missed it. What's important about bold price targets isn't the exact number. It's the direction and the magnitude. A move that large would not be driven by enthusiasm. It would be driven by necessity. It would reflect a market repricing silver, not as a cheap byproduct metal, but as a strategic asset in a world short of trust and long on demand. Skeptics will say such prices would kill demand. That's a misunderstanding of how essential materials work. When something is critical, users don't stop buying because it's expensive. They adjust budgets. They pass cost along. The world didn't stop using oil. When prices rose, it adapted. Silver in many applications has no easy substitute. That gives it pricing power most people underestimate. There's also the issue of leverage and paper exposure. Much of the silver market exists in claims, not metal. That structure works fine when confidence is high and delivery is rarely demanded. But confidence is fragile. When enough participants decide they want the real thing, not a promise, the math changes instantly. You don't need everyone, just enough. At that point, price becomes a clearing mechanism, not a negotiation. Another mistake people make is assuming authorities can control outcomes indefinitely. They can influence behavior, delay consequences, smooth volatility for a while, but they cannot create metal. They cannot force production where geology and economics don't allow it. Eventually, markets resolve imbalances the only way they can, through price. This is why dramatic forecasts shouldn't be dismissed as fantasy. They should be examined as stress tests. Ask yourself what would have to break for silver to be revalued that way. What would have to fail? When you start answering honestly, the scenario stops sounding impossible and starts sounding uncomfortable, which is exactly how reality announces itself before major shifts. I'm not impressed by predictions. I'm impressed by alignment. When technical momentum, structural supply issues, monetary pressure, and investor psychology begin pointing in the same direction, ignoring them becomes a choice and usually an expensive one. Silver appears to be approaching that alignment. Markets don't move because people agree. They move because people are forced to react. If silver reaches levels that seem unthinkable today, it won't be because someone guessed correctly. It will be because the world changed and silver simply reflected that change faster than most were prepared for. And that's the real lesson. The future rarely arrives gently. It arrives all at once. And it punishes those who mistook comfort for permanence. When people talk about silver, they often separate the story into neat categories. Investment demand over here, industrial demand over there. That's a convenient way to think, but it's not how the real world works. In reality, those forces collide, and when they do, the market doesn't adjust slowly. It recalibrates violently. Silver is one of the few materials on Earth where that collision is not only possible, but inevitable. Industrial demand for silver isn't speculative. It doesn't care about sentiment or headlines. Factories don't pause production because a market feels overbought. They consume metal because they must. energy systems, electronics, medical technologies. These aren't trends, they're infrastructure, and silver sits inside all of them quietly, invisibly, and indispensably. What makes this moment different is scale. The world is undergoing a structural transformation that requires more conductive materials, more efficiency, more reliability. Silver happens to be exceptionally good at what it does. And there are very few substitutes that perform at the same level without trade-offs. That means demand isn't just rising, it's becoming less elastic. When price goes up, usage doesn't disappear. It shifts priorities elsewhere. At the same time, supply is constrained in ways most people don't understand. Silver is rarely minded for its own sake. It comes as a byproduct of other metals, which means production decisions are driven by entirely different markets. Even if silver prices surge, that doesn't guarantee more silver shows up. You can't flip a switch and produce more of a byproduct. That structural mismatch between demand and supply is a recipe for pressure. And pressure in commodity markets always expresses itself eventually. Sometimes through shortages, sometimes through backwardation, sometimes through sudden repricing that leaves analysts scrambling for explanations after the fact. Silver has shown early signs of all three at various points, which should tell you this is not a hypothetical issue. What complicates matters further is the competition for the same ounces. Industrial users want silver to keep production running. Investors want silver because they don't trust paper. These two groups don't negotiate with each other. They bid. When they start bidding at the same time, price becomes the only referee. History shows that investors, when motivated by fear or preservation, tend to be less price sensitive than manufacturers. That's when things get interesting. Another overlooked factor is stockpile depletion. For decades, silver benefited from above-ground reserves accumulated in earlier eras. Those buffers have been drawn down quietly year after year. Once they're gone, the market has no cushion. Every ounce must come from current production. That's when volatility stops being an exception and becomes the norm. People assume technology will solve everything. Sometimes it does, but not on demand and not without cost. Substituting silver in high-performance applications often means sacrificing efficiency, durability, or safety in a competitive global environment. Those sacrifices matter. Companies don't make them lightly, and certainly not quickly. This creates a situation where silver demand is not only rising, but becoming strategically important. When materials move from being cheap inputs to critical resources, markets reprick them abruptly. We've seen this with energy, with rare earths, with food. Silver is following the same path, just with less attention, which usually means more upside when reality asserts itself. There's also the geopolitical layer. Supply chains are no longer treated as neutral. Countries are reassessing dependencies, stockpiling resources, and prioritizing access. Silver doesn't exist in a vacuum. When strategic thinking enters commodity markets, efficiency gives way to security. That shift almost always supports higher prices. What many fail to grasp is that silver doesn't need a crisis to move. It needs friction. Small disruptions, competing priorities, and rising mistrust are enough. Markets don't wait for perfection. They move when balance is lost. And silver's balance has been eroding for years. I've always believed the most dangerous words in investing are, "This time is different." But sometimes the structure truly does change. Not because of ideology or narrative, but because of math and physics. Demand growing faster than supply isn't an opinion. It's arithmetic chore. When that arithmetic finally overwhelms assumptions, silver won't rise because it's fashionable. It will rise because it's necessary. And necessity in markets has a way of silencing arguments very quickly. So volatility scares people who don't understand markets. But it fascinates those who've lived through enough cycles to recognize what it really means. Calm markets are usually complacent markets. Violent markets are honest ones. When you see sharp moves, sudden sell-offs, and confusing price action, it's often not a sign that something is wrong. It's a sign that something is changing. Silver is entering that phase. Many investors assume that when a story is strong, price should rise smoothly. That's a comforting illusion. In reality, the most powerful trends are the most unstable in their early stages. Competing interests fight for control. Old positions unwind. New players enter. The result is chaos on the surface and structure underneath. Silver's behavior fits that pattern precisely. Risk in silver doesn't come from owning it. It comes from misunderstanding it. People buy it expecting stability, then panic when it behaves like a commodity instead of a savings account. Silver has always been a metal of extremes. It moves too fast on the way up and falls too hard on the way down. That doesn't make it broken. It makes it honest. What's dangerous is assuming that volatility means the thesis is wrong. In strong commodity cycles, volatility is the cost of admission. Prices overshoot, retrace, and then overshoot again. The people who survive aren't the ones who predict every move, but the ones who understand why the market is unstable in the first place. There are structural reasons for this instability. The silver market is small relative to global capital. It doesn't take much money to move it, especially when liquidity dries up. When large players reposition, prices gap. When paper exposure unwinds, price doesn't drift. It jumps. This isn't a flaw. It's a feature of a market that's been suppressed by leverage and neglect for years. Another source of volatility is conflicting time horizons. Traders look for short-term moves. Industrial users look for continuity. Long-term holders look for preservation. When these groups act simultaneously, price becomes erratic. That erratic behavior doesn't invalidate the trend. It exposes the tension beneath it. People also underestimate how rare balancing and forced selling can distort price temporarily. Index adjustments, margin changes, and risk controls can trigger selling even when fundamentals are improving. Those events shake confidence and create headlines, but they don't change supply and demand. They change positioning. Experienced investors learn to separate the two. This is why sharp declines often occur in the middle of bull markets, not at the end. They exist to transfer ownership from weak hands to strong ones. Markets are ruthless teachers. They punish certainty and reward patience. Silver, more than most assets, tests conviction. The irony is that volatility often increases just before a market is repriced higher. As pressure builds, the system struggles to maintain balance. Think of it like a fault line. Small tremors don't relieve stress. They signal that stress is accumulating. When the release comes, it's decisive. For those who only look at price, these movements feel random. For those who look at structure, they're informative. Each violent move reveals where leverage exists, where liquidity is thin, and where assumptions are fragile. Silver has been exposing all three. Risk management in such an environment isn't about avoiding movement. It's about understanding your own limits. Know why you're involved. Know your time horizon. If you can't tolerate swings, you shouldn't be there. Markets don't adapt to investors. Investors must adapt to markets. What concerns me isn't volatility itself, but how unprepared people are for it. Years of engineered calm have convinced many that sharp moves are abnormal. They're not. They're the mechanism by which markets restore balance after long periods of distortion. Silver doesn't promise comfort. It promises truth, and truth in markets is rarely delivered gently. The next phase will likely confuse, frustrate, and exhaust many participants. That doesn't mean it's wrong. It means it's working. Those who survive won't be the loudest or the most confident. They'll be the ones who understand that volatility is not the enemy. It's the message. So here's my final word. Don't watch this unfolding story like a bystander. Engage with it intelligently. Question assumptions. Understand the forces at play. Because whether silver does hit 100, reaches for 200, or encounters violent corrections along the way, what matters most is your ability to interpret the truth of what's happening, not the noise. Remember this. Markets don't care about consensus. They move because of fundamental psychology and macro truth. And right now, the unthinkable in silver may be not distant, but imminent. Invest wisely, think deeply, and never let fear drive your decisions.